Is this still just a standard September setback in the indexes, or do the breakdowns below the surface and the rout in the bond market mean the bulls are losing the benefit of the doubt? Here to discuss that is Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian, good to talk to you. How are you doing?
Thanks so much for having us. Just a normal September in our book.
Well, this is it, right? So by all appearances, if you I guess, sort of pan out, that's what it looks like, right? 6% off the highs. It started right on cue as August got underway. So we needed something like this, maybe predicted it, maybe should have expected it if not. On the other hand, if I look at cyclical stocks starting to struggle, the general market unable to really look beyond what's happening in the bond market, equal weighted S&P maybe breaking down a little bit too, that doesn't cause you to rethink it?
No, it doesn't, Mike. You know, you and I go back a long ways, back to the 90s, and unfortunately, the majority of institutional investors have maybe been in their seat 10 or 15 years, so they've never really seen this. We really think this is all part of kind of returning back to normalization. If you go back to 1950, when you have a return in the markets of over 15% through August, you typically have a very strong end of the year around 4%. I think 4% is the magic number. The 4% is the average fourth quarter return since 1950. 4% is the average return when you see a negative September. So I think that's going to end up what's going to happen. I think as I go around and talk to clients, Mike, institutional clients are underperforming. Long only missed the January, February initial move in the markets. Hedge funds are dramatically underperforming because they've been so negative most of the year. And obviously, they love this action in September. So I think earnings have come in and they've been pretty solid. And I think third quarter earnings are going to be pretty good as well. So I think we have a pretty decent chance at a liftoff. And history shows that it's pretty normal to have a liftoff, especially considering how strong the first 8 months of the year were.
Right. No, everything does line up. If you're going to be kind of combing through the archives and saying what other situations match up to the market experience of this year, it's generally pretty encouraging. I guess the only question is, in July we had a pretty solid consensus that a soft economic landing was very likely, and people seem to be positioned roughly accordingly. Now, it's a little bit of doubt creeping in, or maybe a lot of doubt creeping in. Do you think the economy can handle what 7.5% 30-year mortgage rates and, oil prices at $90 a barrel can throw at it?
I think so, because first off, on oil, it's demand outstripping supply for the first time in a long time. And I think coming off of what we had a very strong summer in terms of people traveling, and it's really a supply issue right now trying to match up with demand. Now, we'll see what happens a year from now. When you kind of look out and plan how, when you're building out on the corporate side, I think that energy cost is going to be going down next year. That's number one. In terms of the economy, look at how some of these consumer stocks have actually held in there quite nicely. And I think heading into the holiday shopping season, I think there's going to be some very strong kind of have or have nots. It's going to be really the online side's going to do really well, high end's going to do really well, and kind of the lower end, kind of the consumer staple-ish type consumer stocks, and that would include Costco and Walmart. But on the online side, we think Amazon is primed, not to catch the pun there, to really rebound. Remember, Amazon had a tougher year last year, so we think Amazon's actually quite well positioned heading into the holiday.
Does that go for other stocks in the Amazon category? By that, I mean, the $500 billion and up kind of consensus favorites among the growth companies, the Magnificent Seven, whatever you want to call it. Because as much as they've come in off their highs, they haven't really surrendered any relative performance to the average stock since the top of the S&P 500 in late July.
They really haven't, and that's a wonderful point. So you kind of go back to this term normal. We've seen, quote unquote, normal corrections in these stocks, and I think it's quite healthy. These, what we would like to call them, the consumer staple-ish type tech, meaning Apple, Microsoft, Google, Netflix. We've had really healthy kind of pullbacks and opportunity to, I think, add to positions, kind of core positions over the next 3 to 5 years. In terms of the high multiple names, even some of the forward multiples on NVIDIA and like are looking more attractive. We've said all along that you want to kind of be more growth at a reasonable price and map out a high multiple name with a lower multiple name, especially in the semiconductor space. And I think that's what's really going to help portfolio positions and more of this kind of stock picking going forward.